On board George Alexander Muthoot, MD at Muthoot Finance, and talk about how their business is looking like right now. And George, given the fact that gold continues to hold at an uptick, I'm sure better performance from you in the next quarter too.
Yeah, thank you. Good morning. I think the last 6-7 quarters have been good for gold loan companies and especially for Muthoot Finance also. We are happy on that. We are still seeing good demand for gold loans. There is a good demand coming from the cities, coming from the rural sector, coming from the Tier 2, Tier 3, everywhere there is good demand and pickup for gold financing.
George, if you look at gold prices, they are almost inching to all-time highs. What is kind of risk mechanism that you're putting across while lending to across the board or segments?
Yeah, in the last 2 years, if you take exactly the 2 years, in the last 2 years, gold prices, which are about $2,000 per ounce, has now touched 4,000. Consequently, the same 100% increase is there in India also. So gold price has really peaked and is still holding high because of the international instabilities, maybe trust deficit between countries, etc. I think the countries are also holding gold. So gold price is now elevated. But your price about the risk, actually today, it's not everybody is not taking the full value of the gold which they need. Today, if you look at Muthoot, on our AUM, the average gold loan they have taken is only 60% of the value. Only 60%. So there is still room and people are not borrowing to the hilt. Just because the price has gone up, people are not borrowing. Of course, for some people, it is quite advantageous that with a smaller amount of gold, they can get more money, but not that everybody is taking or borrowing to the hilt. Moreover, if you ask the risk, we give only gold ornaments, and in ornaments there is always a making charge of about 15%, which is above the price of the gold and also the sentimental value. We give only for household ornaments. So these are our traditional risk mitigation mechanisms, and over the last several years, we have seen gold price cycles going up, coming down, etc. But people have not just abandoned their ornaments. So that is what we feel is the risk mitigation measures we have with us. And it has steadied, and it is finally, we have proved it also that it is not, we don't have any NPAs or write-offs in the last several years, even when the gold price peaked and the gold price came plateaued, and probably in some times it came down also, we did not lose money.
George, what has been the average tenure of these loans for you, and are you seeing your customers coming back and pledging gold again as the prices go up?
Yeah, yes, no. I think you have said two things, right? Yes, the average tenure of the loan is, although we give it for a year, its average tenure is only 3 to 4 months because they are taking back the gold to return it to the family. So it is a family's gold, so they return it as the first opportunity. Now, 80% of our customers come back when they need a second loan. So they take a loan today, probably they close it in 1 month, 2 months, 3 months, 6 months. And then whenever they need a second loan or a loan again, they come back to us. Your point that they're taking it again because of the price rise? No, they're taking it because actually they need it. In fact, if you look a little one step back, if they really needed the full money, they could actually sold these ornaments and got all the 100 rupees instead of taking the 75 rupees. So, but what they feel is there's temporary setback, temporary funding crunch, so they take the gold. And whenever that funds come back, they release it and give it back to them. So that's what we see. And maybe among the loans we give, not more than 2% go beyond the 12 months.
Okay, and Mr. Muthoot, you very recently raised your FY26 gold loan guidance, and it's been a steep hike from 15% earlier to 30 to 35% now. Are you on track to achieve that? And given the way the gold prices have been trending, would you like to make any adjustments to this guidance?
Yeah, I think we are the guidance which you gave was 30 to 35% of the guidance we gave in the last quarter. So probably after the end of the quarter, when we announce the results, we will see whether the guidance need to be revised. But to answer your question, we are seeing good pickup in demand. That's what I said in starting also. There's good demand for gold loans in the rural sector and also in the cities and towns, etc. So we don't see anything which is negative for gold loan growth in the coming quarters also.
Okay, and other than gold loans, just pivoting away from gold loans for a bit, Mr. Muthoot, how are your other segments doing, like MSME, microfinance, personal loans? How are they shaping up?
Yeah, I think 90% of our portfolio is gold only. Of the 10%, maybe about 7% of the portfolio would be, or 6% of the portfolio would be in the microfinance. Microfinance is going through a stress, but I think it is reaching the peak of its stress, and not the peak is coming down, and we see better recoveries, and I think more discipline among the microfinance lenders also, so that everybody has actually tapered their growth, etc. And we also had a portfolio of about 10,000. Now it is only about 7,000. So everybody is a little cautiously looking at it. And we see the NPAs or the bad loans coming down. So we should see growth or the collections picking up from today. And the next 2 quarters, we should see the sector coming back to its health. Other sectors which you have is the home finance, which is a small portfolio, about 3,000 crores. It's doing well. It's again a secured loan. And some small bit of about 3,000 crores of personal loans to salaried customers. Also, that also generally we try to give it to customers who already have some relationship with us. That's what we started that sector. That's also growing okay, but not as well as the gold loan sector.
George, you have projected for a lower cost of fund going forward in the coming quarters. How are you going to achieve that? And do you see your interest margins going up as a result of that?
No, sir. I think what we do is our lending rate or the borrowing rate is fixed to the bank's MCLR. The bank's MCLR, although the banks have reduced their rates on loans to individuals and other companies, the MCLR reduction is now slowly happening only. It's not as fast as the reduction in the direct lending by banks. So gradually we are seeing a reduction in the MCLR. Maybe today the rates are about 8.5 to 9%. MCLR will start slowly coming down, maybe another 20-30 bips. It's nothing more than that. Our coming to our margins, we ensure that we see that our NIM is around 10%, 10.5, and we will continue to do that. As and when the cost of borrowing goes up, comes down, we actually reduce our yield also. So we pass it on to customers. We are more concerned with our margins, which we'd like to keep it steady.
Right, understood. Mr. Alexander, great to have you today on the show. Thank you so much for your time.
Thank you. Good day.